everyone, and welcome to the Wealth Builder Masterclass. Thank you for joining again today with an awesome guest. And I know that we all are looking for the good opportunities and obviously a lot of money that we can raise from the people. But I think everybody's asking, where did the capital go, right? Do you have that question too? I hear that. Me and Gino, we were talking before the recording too, and Gino was saying the same thing. Where did the money go? Or where are the deals? We are not finding any good deals, or we are not finding any capital either. So that's what we're going to talk about today. So let me introduce Gino first. Gino is our good friend. He's an investor, he's an entrepreneur, author, a business coach, co-founder, and now I think he's teaching a class or a course on the money, how to manage money. Oh my God, you're awesome. You wear so multiple hats, and then you have built a substantial multifamily portfolio, like you mentioned earlier. So today we're going to be talking about the changing market cycles. So welcome, Gino. Super excited to
Thank you.
have you with us today.
Thanks for having me on. And to address the point that you just made right now, where is the money? I was reflecting on this during the week, and I was thinking about the last 12, 18 months, how it is challenging to, find the money. And I'll give you an analogy. If you're a child and you go to a stove, the stove is cold, you touch it, it's okay.
Mhm.
Now, if you think about the stove being hot, child touches it, he gets burned. He's like, okay, I'm not touching that stove anymore. And I think that's what's happened over the last couple of years. The LPs were touching cold stoves from 2014, 2015 up until 2021, 2022. They were doing really well. There was nothing to be worried about. They kept getting their money back every 18 months. And then all of a sudden, the market cycle shifts, things get a little different, and now the money's locked up. There's a couple of reasons. The first one is that hesitancy because they've gotten burned. The draws have stopped on a lot of these deals. The capital calls are coming right now. Some deals have gone into foreclosure. I think that's the first reason. The second reason is that their money is locked up right now in a lot of deals. They haven't gotten their money back. They were told you're going to get your money back in 18 months to 3 years. Well,
I
you're in
know.
year 4 right now and your money's locked up. So if you're a GP or a sponsor, you have to understand that that's what's going on. It may not be just your fault. You may suck at raising capital, but that may be one of the reasons, but there's other reasons out there. And I think the third reason is, to me, is the high rates and the uncertainty. I mean, high rates shouldn't stop you from doing deals, but if you're getting deals and rates are 6.5% and cap rates are still 5 or 5.5, you're buying at negative leverage. It's so hard to get returns for your investors. So right now, the function of the market, where we are on the market cycle, is making it difficult to find deals. And then when you do find a deal, it seems as if a lot of sponsors are just racing and they're not prepared for, raising capital is a business in and of itself. That is not has nothing to do with acquiring deals. You have to have a team of people, if you're not doing it yourself, to help you with that, with the CRM, with the messaging, with the constant touch points, with building a brand. That's in and of itself exclusive. You can't just hit the button and go, I found the deal, now the money's going to come to me. It doesn't happen like that anymore because there's so much noise out there and there's so many people in the market that you need to stand out and you need to be consistent and you need to be in front of people who are actually looking to invest in real estate.
That's true. I agree with you. Like before we dig deep, let's go through a small little disclaimer. So today's discussion is 100% educational, and now we have no legal advice, no financial advice, and not even a solicitation to invest. So if you have any legal or investment related questions, please reach out to your own professional advisors like your CPAs or attorneys. And a small housekeeping item, if you have any questions, please use the Q&A box throughout the session for any questions that you would like us to address. And you're welcome to participate anytime because it's a kind of a fireside chat, Q&A kind of thing that we're doing. And our topic once again is why investors are saying no and how strong operators earn trust and raise capital in a more selective market, which we are in right now. So, I mean, we constantly talk about rates, like you were just saying that we're talking about rates, lending, valuations, but we hardly talk about the investors. We just think like we have the deal, we're gonna go raise the capital now. So I'm trying
Mhm.
to understand from you, from your experience, what you're seeing. How has the investor themselves changed over the last few years?
What I've seen over the last few years is, as I just said previously, investors have been burned. And I think when you're burned, you become hesitant. And when things were real easy, it was just easy to stroke a check. You put your money in and then you get your money out. I think what's happened now is it's the land of the operator. And if you don't find a sponsor who can operate these deals and be honest with you, that's what I see the problem is right now. And it's funny, I was on a podcast the other day and this gentleman said to me, "This is the decade of the operator." And I said, I have to respectfully disagree. Every decade should be the decade of the operator. Just because it's been easy the last 5 or 6 years and NOI didn't grow and cap rates compressed, you still should have been operating because you would have made even more money because your NOI would have grown. And then possibly you wouldn't have flipped out of the deal. You would have held on to the deal longer term. I think investors, when they don't have to do that much work and things are easy, there's euphoria, private capital's coming in, interest rates are low, the cost of capital is low. It's just so much easier. And people are just flocking. You can see capital flocking into the market. Right now, where is capital going? Capital is going to the stock market. The stock market is booming. You can see what happened with crypto. Crypto a year ago was over a 120. All the capital is flowing to that market. So you just have to be aware as a sponsor, or as a GP right now, capital doesn't seem as if it's flowing into multifamily. And that's the challenge that we have right now.
Yeah, even if we see that, right? If we have the webinar or they come to the webinar, they attend and they'll ask for the information, you give them everything. Even sometimes I have seen that I send the deal disclosures, all the documents, and after that there's silence. Nothing
Mm-hmm.
happens.
Mm-hmm.
There's a gap between the interest and the action now. So are you seeing that as well, or how you are trying to mitigate that gap?
Yeah, I wrote this down because I think this is important. You want to say, why do investors return? So if you've done a deal or two, these are the 5 things that I think that investors come back or they return to a sponsor. And we had this with our deals. We did 3 syndications. On the third syndication, I don't want to say it was a rather easy raise, but when you have 2 deals that are performing really well, these 5 characteristics really helped us out. The first one was trust. You know, an investor, when he gives you money, Vinky, or she gives you money, they want to make sure the money's coming back. That's their biggest fear. And if you can trust them, even if your deal goes belly up, I'm going to make you whole. It makes them feel better. They want to be able to trust the person that they're investing in. They want to make sure that that money's safe. The second part is the communication. If the deal is going bad, what a lot of operators do is they bury their head in the sand and they don't communicate. After COVID hit, we were having daily figures of how much money we were collecting rents every day. We were doing that. We were doing end of days with every team member. We were doing weekly Zoom calls with all of our investors. Even if they didn't want to get on, they knew we were there. When one of our properties was having major capex issues, every month we were doing the webinar, we would talk about the capex issues. So we knew the communication, and that can be really hard. But if an investor trusts you and you communicate with them, those are 2 powerful things because they know that life isn't perfect. There's a war going on right now. The investor knows that's a black swan event that's been going on for the last 5 or 6 months. But if they trust you and you communicate with them and you keep them top of mind and let them know exactly what's going on, it'll make them feel a lot better. The third one is obviously its performance. How has your portfolio done over the last 5, 6, 7, 10 years? Have you been able to, state a certain IRR or a certain metric, and have you been able to hit that? Obviously, that to me, that's important. The fourth one is ease of process. Vinky, how easy do you make it? And it sounds like you make it very easy for the process to work. When we started, there was no platforms as far as all these different portals right now. Now it's so easy to do that, especially if you connect yourself with a great syndication attorney like Kim Lisa Taylor. You create the documents, you get in a portal, you make things so simple. You want the process to be easy. It's as if you're going onto Amazon, you're clicking a button and you're buying something and it comes to your house. That ease of process will make it a lot easier to get continued business from these investors. And I think the last one, ties it up with the trust and the communication. It's the relationship. I think, to me, you really need to understand and have a relationship with your investors. You need to know, and when you have that first or second call, we're always concerned about ourselves. And this is one of the things that a lot of us do as capital raisers. We're so worried about investing, getting that capital. It's all about us. When in reality, as entrepreneurs, you're creating value for the marketplace. It's all about the investor and making sure that that deal and whatever we're trying to raise fits with them. If it's your last 30 or $40,000 and you're going to invest in my real estate deal, I'm going to say to you, you may not be a good fit. Although I may desperately need that money, you may not be a good fit. That's the relationship, the trust, and the communication. I would say that's like the trifecta. If you can work on that and the investor knows that you have their best interests, I think to me, working long term and trying to raise capital long term, it may be difficult in the next 5, 6, 7, 10, 12 months. But if you're in this for the long term and you can focus on these pillars, I think you're going to have a much easier time building a business with raising capital.
I think I do have a follow-up on that because, a lot of times I have seen that the capital raisers, when they're raising capital, even their operators, they're raising capital for their own deals, they get really excited when the deal comes. So it's just like they do not see anything, only the thing they see is
That's
my
right.
deal, my baby. I need to raise this five,
Yes.
$10 million, nothing else. So at that time, I don't think investors' interest is that important. I don't know if you have experienced that or no. So it's just like the question is based on, oh, okay, what kind of returns you like? It's like, my deal is giving that. So this matches. So it's just like the very surface level match is happening at that time.
Hmm.
And when the investor says, okay, maybe I'm not ready yet. So it's like, and then no, then you get hurt, then you move on to the next one. But in this market, I wanted to know two things from you. Number one, that I think getting too excited is not good because it's gonna burn you. It's not gonna help you that much. And the number two is just like if the investors are saying to you, "Oh, maybe I'm gonna pass or I'm gonna wait." Are you keep nurturing that relationship or are you just putting them aside and just like, okay, forget it?
That is a great question. For me, one-on-one sales, if you smell desperate, they can sense it and they're going to
Mhm.
walk away. There has to be an element of scarcity in every kind of transaction. And you can say to them, hey, great, you know what? Closes Friday is the last, and we had this problem, Minky, because people thought we were full of crap on our first syndication. We raised the money in 48 hours. We raised $2.5 million in 48 hours. We told
Wow.
people we'll put you on a list, but guess what? After this, you're not going to have the ability to invest with this anymore. And some people got really mad. So I think you have to create an element of scarcity. You have to create an element of excitement. And another thing that you need to do as the capital raiser, depending on who you speak to, you have to make it, I don't use the word entertaining, but easy enough for them to understand. Because we're in the world of IRR and debt coverage ratio and equity multiplier and rent growth. And when you're talking to the average person, they don't know what any of that is. That's why what I created with Jake, we created a framework. We created buy right, manage right, and finance right. And when we pitch a deal to somebody, we create it through that lens and we make it interesting and exciting. We talk about how to buy this asset. We talk about a little bit of managing it and we talk about how to finance it. Something very different, something that an investor can walk away and go, oh, buy, manage, finance. Never heard that before. That's pretty cool. I like that. And I think we need to keep it at a surface level depending on who we're speaking to. That's why it's really important when you speak to a new investor, you need to understand their qualifications. Are they sophisticated? Or do they know about real estate? Do they know how this business works? And I think that's important to do. But the scarcity and keeping it simple are important. And, to really round out the question, if a person says it's not for me, great. You continue to chase them. It's not going to work out well in the long run. What you can say is, hey, this doesn't work for you. Do you know anybody that I would work for? Because this is a great deal and it may not be a fit for you now, but you know what? Let me keep on the side burner. And what I would do is I would keep that person not active for this deal, but any deal in the future, because you can go back to them in 6 months and go, oh man, I missed you on the last deal. That deal's doing pretty good, actually. I wish you were on that one. You want to be on this one. Then they get a little bit of FOMO. Then they get a little bit of fear of missing out because our second deal, same thing happened. They missed on the first one. It was a lot easier to raise on that second one.
I think you raise a very good point over here that you ask them if anybody else in their network might be interested. That creates a FOMO too. Because then
Hmm.
you have more confidence in your deal. You're asking them, okay, is there anybody else? Or you don't like it, maybe somebody else will like it. So that creates a little bit kind of competition in their mind, oh, maybe I'm not good for this deal, or this deal is too good for me, right?
Mhm.
So there's a
Yes.
FOMO factor right there too. So,
Yes.
earlier we were talking about how many investors they are experiencing all this delayed exits. Like on my deals, too, multiple deals, we had like 18 months or 2 year exit, and we're sitting year three now. Investors are kind of desperate, they want their money back, but the market is so soft, and the distributions are either paused or reduced, and then a lot of people are doing capital calls, and then, like you say, communication, people are just hiding, I don't know where, not even responding a lot of times. So do you think today's hesitation that investors having is actually a result of all these things happening, or they're just waiting for something else? Because you hear investors saying that too a lot of time. Oh, it's not the rock bottom yet. I'm just waiting for the right time.
When you look at the market right now, there is a lot of uncertainty. I mean, we don't know where rates are. We see the war going on right now. Is there inflation? Is there not inflation? In some markets, there's a lot of deal flow. Let's say Dallas, Texas, right now, there's a lot of deals, there's a lot of foreclosures. But in my market right now, there's not a lot of activity going on right now, and I think people are waiting. It's interesting. We just had an offer. We put on a deal last week, and I mean, we're several $100,000 off the lease that they would take, and they came back to us and they said, you know what, we're going to hold off and we're going to wait till the market gets better. And that's what people are doing right now. They're just kicking the can down the road. And to me, if you have capital and you can find a deal right now, I think you strike. I think if the deal hits your parameters and it hits what you're trying to accomplish, I think you buy the deal right now. That's what we're trying to do. We just can't find a deal, and we're not going to force a deal. We know what our yield is. We know what our cash on cash number is. We know what absorption and delivery is in our market. We know what occupancy is in our market. And we're underwriting for all of those variables. And we're not going to make it as if, hey, rent growth is going to happen this year. In our market of East Tennessee, it's not happening for the next at least 6 to 12 months. So I am not going to have this rosy prediction, but I'm still looking at as many deals as possible. And if something does come across the desk, we will buy it.
So any of your assumptions change in this market compared to what you were doing previously? Are you
Mm.
underwriting it differently, or you have a new set of glasses looking at the deals or the investors? I mean, how has that shifted for you?
People need to understand that, as Mark Twain said, history doesn't repeat, but it rhymes. And when you're looking at it right now, we're not having a total repeating of the last part of the market cycle. But right now, in this part of the market cycle, we're not buying older assets. And if we are buying older assets, we're going to pay a steep discount to them because interest rates are a lot higher right now. And these older assets need a lot more capex right now. We used to get yield to, loan to cost deals where we would get the rehab built into the loan. Banks aren't doing that. Community banks and credit unions aren't doing that. So we need to come out of pocket for that money. So that's a cost right there. The second thing is these older assets, the rents are really challenging right now. Where rents were going up a year, 18 months ago, right now rents in our market are flat. They're actually down 0.8%. A year and a half ago, occupancy was at 94, 95% physical. Now we cannot break 92% occupancy. That's the reality of our market. And if we get 90% occupancy, that's really good. So we're saying to ourselves, we're not going back to 95% in the next 12 months because we still have a lot of supply that needs to get burned off. And I think the last thing that's been shocking to us is the expenses on these properties. Our expenses have gone up. It used to cost between $6,000 and $6,500 per unit to run an asset in our market. Now that's inclusive of capex. Now it's over $7,000. So if you think about it, that's about $650 a month just in expenses. So if you're renting an apartment for $1,000 and you have to pay $650 in all expenses, you have $350 left to pay the mortgage. That's why a lot of these deals aren't penciling out because rents have just stalled. Whereas 3, 4 years ago, rents were going up at a nice healthy clip because there wasn't enough supply. Now you have to actually assume no rent growth, and you have to assume that expenses are going to go up several percentage points right now.
Wow. So how people are making money who are getting into the deals now?
That's a great freaking. I keep asking my business partner, like, how are these deals penciling out? I think what's happening is There's certain people that have a ton of capital. They put a lot more money down, so their loan to value is lower. There's only two ways you can make a deal work. You either put more money down, right, or you lower the price. So they're not lowering the price, so they're coming in with a lot more money down. And I think people may be very, what's the word, confident of the next 24 to 36 months. They're like, hey, we're in a lull right now. But if I can make it through the next 24 months, if I can make it to where interest rates drop, maybe I'll refinance out of the loan that I have now and get a new loan in 24 months. Oh, that's great. I'm going from 6.5 to maybe 5. I just I don't want to invest like that because I don't know what's going to happen with interest rates because the experts told us 18 months ago, 2 years ago, that rates were going to drop. And here we are right now. So it's very interesting. Some people, they're buying these deals, and I don't think they understand the operational side of it. I think they're underestimating expenses. And then when they get on the deal, it's like, wow, I didn't know it cost this much to run a deal. And they're barely treading water right now.
And that's a speculation actually, because you're betting on the future. You do not know what the future is gonna be. What if there's
Yes.
a world war? I don't know. I mean,
Yes.
the way things are going, we've been in the war for many days now, so it's not
Hmm.
coming to any resolution. So it's just
Hmm.
like just betting on future. I'm not sure that's the safest bet in the current market. So I'm not sure why people are doing that. That's kind of crazy to me.
Sometimes you have capital and you get theritis. It's like you just want to do a deal. And I've been there. I did a deal back in 2007 in the last market cycle. That's why, to me, my favorite phrase is no deal is better than a bad deal. And I've done bad deals, and that's why I can confidently say that. And everyone says this too shall pass. This market too shall pass, and we are going to get deals coming back because sooner or later people are going to have to sell. They can't hold on forever. And I think if this market stays the way it stays, there's going to be certain sellers out there that are going to have to sell their assets. And we're just going to need to have a little bit more patience.
So let's talk about some of the deals, that people are doing the recap or they're doing the rescue funds. So those are like very common terminology that we hear in today's date. And at the same time, they're raising millions for their new deals too.
I
How do you justify that?
I'm baffled by rescue fund. I mean, the deal wasn't good when you bought it. Now you're going to try to rescue it. Now it makes absolutely no sense to me. I don't know. And the fact that a lot of these younger investors had a fund that went bad and they go open up and do another fund that the first one didn't go well. How do you expect to do the second one? To anybody out there who's looking to invest passively or looking to invest with one of these sponsors, we have a 3-step framework. And, I'll share this with everybody because this saved me millions of dollars. I made this mistake. But when you're investing with somebody, the first part is the sponsor itself. There's so much information out there now to find out about sponsors, to find out about their track record, to find out about their business plan, to find out about their returns, to find out about their losses. And I'm not saying that, when an investor loses money, you shouldn't invest with that person. What I want to know is what did they do from that adversity? I can tell you what I did from my adversity when I lost the deal back in '08. I didn't have any investors. It was myself. I made us whole. I learned through the process and I told myself I will never do bridge financing. I will never get short-term debt. So when this crash came out in 22, 23, I said, Jake, we are not doing bridge financing. It's too risky. There's a time constraint on it, and we can't allow it. So when you're looking as a passive investor, the 3 steps are: you look first for the sponsor, and you look at all those things that I mentioned. But then the second part is you look to yourself. And as the investor, you want your interests to align with the sponsor. If the sponsor's telling you 3 to 5 years and you're gonna have your money at least 5 years, just know that your money is not going to be accessible for at least 3 years, possibly 5. Are you good with that? If you're not good with that, then don't go with the sponsor. I mean, I want the sponsor to invest money in the deal themselves. I want them to have skin in the game. In my very first deal that I did with an investor over 20 years ago, they had no skin in the game. So when the deal went belly up a year after I invested, they just walked away. I lost all my money. They didn't lose any of their money. And that didn't sit well with me. So if I'm going to invest with somebody, I want to align my interests with that person. I want them having skin in the game. I think the other part with aligning your interests is, does it fit your objectives? What are you trying to do with investing? Don't just go chase IRR. Don't go chase yield. Chase a strategy. What are you trying to accomplish with real estate? And I think most people are just trying to find a deal. The third part is the deal itself. Don't worry about the deal unless you like the sponsor, unless you like the alignment of interests. Is the sponsorship group charging you too much? Are their returns fair? Do you like the sponsorship group? You need to look at everybody on that sponsorship group. We just mentioned Kim Lisa Taylor as the syndication attorney. Do you like their cost seg? Do you like their property management? Do you like their asset management? Have you looked at every single person who's on the general partnership? If you can reconcile yourself and you like the team, that's what I'm talking about with the sponsorship. The deal is the last component. Once you've found the sponsor and once your interests align, now let's talk about buy right, manage right, and finance right.
You raise a very good point, and at this time, I would like you to talk a little bit more about or get a little bit deeper upon this subject on the deal versus sponsor. Because the people who are investing, especially the investors, they're not just investing in a deal, they're investing in a team, right? Because that's the people they're gonna interact with. So
Mm-hmm.
they own a percentage share that's floated based on that deal, the physical asset down there. So it's not necessarily you're buying a physical asset, you're getting a share in something. And it's very, very important, like you say, to trust the team, check their track record, and do all the due diligence. So that's the difference I want you to go a little bit deeper on to help people understand that this is very important subject. It's very
Mm-hmm.
important to learn about the team than the asset itself. Because if the team is good, they'll survive any market. Because they
I
always
love,
have a backup
yeah,
plan.
I
They
love
always
that.
have a backup plan. And most of the operators, they don't even have a backup plan. This something happens. Oh, I don't know. I do not know what to do. I do not know what to do. So you don't want to work with somebody who says, I do not know what to do.
Hmm. For me, when you're working with these groups, most investors, especially when they're starting out, make the mistake as I did and don't understand that real estate, I think specifically multifamily, especially multifamily, you're buying a business. You're buying a
Exactly.
future stream of revenue. You need to understand that it's not passive. It's passive to you because you're investing passively, but you need to have a group that understands that has a business plan and that has a framework and says, oh, wow, I'm going to treat this thing. And what I would do, one mistake that I made, especially if you're investing and you just started out, one mistake that I made early on was I didn't get on a plane and I didn't go look at the asset. If I had done that, I never would have invested with that guy. I would have gone on the property and gone, this is what we're buying. Like I didn't know what a cap rate was. I didn't know what a cash on cash return was. But if I had seen the property, I probably would not have invested. Back then, you couldn't have just gone online and looked at stuff. Now you can do a deep dive. I would literally call the property up and I would do secret shop. I would secret shop the property management company. I would walk on the property, take a look at the property itself, see how it's managed. I would dive into the property management company, whether they're managing it themselves or they're getting third party, because the property management is the customer experience, is the group that's going to run the asset. That's where you make money in this business, by operating the asset. And then the asset management part of the business, which is separate from property management, they are managing the property manager and they're managing the investors and they're managing the assets. So those two delineations have to be separated, but those two have to be looked really closely together. And if you don't understand how they operate and how they function, that's the problem. But the investor also needs to understand, is this deal fit my criteria? Like, why am I buying this deal? Am I buying it just because I got some extra money here? Or am I buying it because it's a long-term kind of play where I'm going to build up some type of assets and at some point I'm getting some type of cash flow that's recurring to me? I think that's what people really need to understand.
And I agree with you that. And then I think a lot of people need to have some clarity there because there is like the clarity piece is missing for a lot of time. Because
Mhm.
sometimes people are doing it. Oh, my friend is doing that. He made money. He doubled up in 3 years. Oh, that
Yes.
person did it. Let me do that. Oh, my aunt did that. So a lot of times is that's the reason, right? So
Yes, and when you're talking about raising capital, and you have those kinds of stories, and it's very you get people who are doctors or lawyers, and they've got friends who are investing in deals, and then all of a sudden you're going to raise. That's a great way to get referrals. That's how you should build your business. If you've done raises with doctors and you've done a really good job with them, make sure you tap into their network because they like to talk and they're around their own water cooler saying, "Hey, you know, Gino's deal, he did really good. I think I'm going to invest in his next deal. So that you have to be out there and be asking people. That's what I think you have to keep top of mind to these investors. But don't go invest in a deal just because your friend invested in a deal and he
Interesting.
did a good job. You really need to take a deep dive. And it's so interesting because people will say, well, you know, it costs money to fly in a plane and I got to take a day off. But if you're investing $50,000 or $100,000, wouldn't it be wise to spend 500 or 1,000 just to make sure that you're making the right decision?
Great. Great. So you were earlier talking about the due diligence, how we should look at the operator and all that. So let's talk about a little bit about the risk as well. Some operators, they really worry, like if I give too many details out or I discuss the risk too much openly, it's going to scare away the investors, right? They're not going
Mm.
to invest with me. So can you explain, like how somebody can handle that, or how do you discuss the risk intelligently and without any fear or without any kind of hesitations there? So because I think investor deserve to know everything, whether it's the good, the bad, the ugly, like you were saying earlier. And then if you keep them misinformed or if you hold some information back, to me that's a misinformation, and then that comes back later and bite you.
I agree with you 100%. There is good, there is bad, there is ugly. Yeah, you're buying a 1970s asset. This is an old asset. We may have to do a lot of capex, but we're buying it at this price. And depending on the type of investors that you're speaking to, if they're not savvy, if they get overwhelmed, there's some details you may not give to them. You can put together a webinar for them, and you can record it and send it out. One of the things that the typical capital raiser makes, one of the big mistakes that they make is they speed up. And I was talking about this the other day. I think we need to slow down in order to speed up. And I think when you do your investor deck and you do your pitch deck, you really should start all of those with the story. And now, depending on what kind of story you'd like to start it out with, maybe you start out with the story of the property, of how you found the property. Maybe you start about a story about, hey, I got into multifamily because of this type of deal. You have to make it personable. People like stories. And if you start jumping into the deal right away, they're gonna get lost. I mean, Oren Klaff says it best. He wrote the book Pitch Anything. He talks about the three types of brains we have. He talks about the croc brain, the midbrain, and the neocortex. Now, when we pitch a deal, we're pitching it from our neocortex, our developed brain, our cash on cash, our logical, our rational brain. We're pitching to a person to their croc brain. And their croc brain is the one that's reptilian, is the one that's the most primitive. It's the one that seeks movement. It seeks something different. They can feel if something's off. So if you start out going from neocortex to their croc, you're going to lose them. It's as if you're just pitching to them and they can feel it. The idea is really to make something different. So when I say, hey, we're buying this thing right, we're managing it right, we're financing it right, and multifamily is a basic human need. It's food, clothing, and apartments. That's
Mhm.
something different. They're gonna be like, oh. Or you can start out by saying, hey, the stock market is doing great, but guess what? It's at an all-time high. There's a lot of risk. Inflation, well, this asset right here, this is a real asset. You're buying a basic human need. You can't buy this on the internet. All of a sudden, I'm speaking to their croc brain, and then they'll let you in. Then they can start listening because they're like, this is something different. I've never heard of this before. Or you can make it about them. That's why asking questions and being relational to them is important because the croc brain senses that. Then it allows it to go to their midbrain, where it's their emotional part of the brain, and they're processing it. And then you can lay on the IRR because now you've got their attention. But most of us do it the opposite way. And I had a student tell me this about a year ago. He said, Gino, I had such problems with my pitch deck. I would go in, I'd start throwing out numbers. I'd talk about what this deal is great. I'm raising rents by $100. I'm putting in dog park. And he's like, all I did was I started out with a story and I had people's attention and I just had no problems raising money. And I'm like, he's like, can it be that simple? I'm like, sometimes it is that simple because we want to rush things and we're the experts and we think that they're the experts when in reality, most people don't know about real estate, but you have to be open and honest and entertaining and allow yourself to get into their croc brain. And then once you are, then that's the invitation to start talking about the deal.
Let me ask you a follow-up. So, which part of the deal structure matter far more in today's market than before?
as deal structure as part of what do you mean by the deal structure? You mean the returns or the like the splits? So I don't think that's changed that much. I think I've been talking to people. It's an 8% preferred rate of return. A lot of people are doing 70-30 splits. Now, if you're new, you may have to do an 80-20. You may have to give more on a preferred rate of return, but it seems as if it's the 8% and 70-30. And it had, to me, doesn't seem like it's moved that much. It's just very hard to hit an 8% preferred rate of return right now on some of
It
these
is. It is.
deals because you've got to get 8% and then you have to get 6% interest rate. Let's say you're at 14%. It's very challenging to do that unless you have a very heavy value add lift, but you have to explain to your investors you may not see cash flow for the next 24 months. Are you okay with that? What you were just talking about 5 minutes ago, are you going to be open and honest with them and say, hey, you're not getting 8% now, but you're going to get 8% with catch up. If you don't get it year one, you're going to get 8% plus 8% for year two. So it's you have to be very open. But I think that's what the splits that I'm seeing right now in the market.
Yeah, but I see 90-10 as well. I see 80-20.
90-10.
Yeah, I see 80-20 very common. I'm seeing 90-10 as well in today's market. I did see on few of the
So
deals.
let me ask you a question. Would you do a deal in 90-10 right now, knowing what you know, with all the hard work, with all the risk, with the residents blowing you up, with the property management, with the asset management? Would you do a deal 90-10? I mean, that seems like a lot of work for
It
10% of
is,
people.
but I think it's just for the institutional level investors. Somebody's coming at the large amount of money. Like you do not have to
Yes.
deal with like 50,000, $100,000. If somebody's coming million, 2 million, 5 million, it's okay to
Yes.
do that in that
Hmm.
scenario.
Does anybody have any questions? You should ask Minky. I mean, I can't really look at the chat right now. I haven't been looking
Yeah.
at the chat, but if anybody has any
Let me
questions,
ask,
throw them in the
do
chat
you
box.
guys do you guys have any question? Please use the chat or the Q&A. Um,
Oh, yeah, Q&A.
we
You're
are on the
fancy
roll.
here.
We are on the roll just talking. Yeah, you guys are there listening to us. Please ask any questions. And by the time they're coming up with question, let me ask you the next question. So you know how we were talking about earlier, investors over deals while people getting into the bridge lending 3 years and 2 years, like add on to it, year and year, one plus one, three, one plus one. And then most of the deals were like 3 years, 5 year whole time period. But that has been shifted now, right? It's not
Mhm.
exactly the same. So market is not following the timelines that was set. So how should operators set expectations today when the right exit maybe take much longer than was originally expected?
That's challenging to tell investors we've got a 5 year hold and possibly longer. I mean, if you're going to tell investors that you're going to hold for 10 years, I don't know what percent of investors want to hold that. I mean, I would, because if I'm going into an asset, I've held a lot of these deals for 10 years. And I can tell you the deals that I bought in 2014 and 2015 and 2016, we still own them. They have made me extremely wealthy because I didn't sell. And I think people are cajoled or tricked into the market of thinking about the velocity of money, getting money back. To me, it's a real interesting, I don't want to say conundrum. I don't know what the word is, but if I could put my money and give it to Vinky and she could hold that deal and she can continue to pay me out every year and we're paying down the mortgage and I've got the cost segregation there and the assets in a good market and rents are continuing to grow and I don't have to sell to trigger any type of taxable event. And then when Vinky finds another deal, well, I've got to pay her again for asset management fees and acquisition fees and all that. Well, why would I just want to get rid of that one deal? And I'm looking at it from the investor's perspective, not from the capital raiser's perspective. I'm looking at it from the investor's perspective. I'm like, I would love to hold on to some of these deals, especially if I like it, if it's a newer asset in a great market with job growth and population growth, and it's just a well-built asset. And I know if we can hold this for the next 5, 6, 7, 10 years, keep my money. Just continue to give me profits every month. Maybe that's one deal that I want to do. And maybe you can have a different option for types of deals. Maybe you buy a deal that's build to rent. That's a little bit more speculative. Maybe you buy a deal that's land. Maybe you buy a value add deal, and then after 3 years, you exit it. Once you become really sophisticated as an investor, you can, as an LP, as a limited partner, have different opportunities or different strategies. No one size fits all. But for me, I would love to hold deals longer term. And I know a lot of investors are turned off by that. They're like, no, I want my money back. But if you have money in an IRA that you're directing, do you really need that money back? You don't need that money back. You should have the money sitting there and letting it grow. We've bought assets back in 2016 for 45,000 a unit. They're worth 145,000 a unit right now. They've just grown in tremendously. We've paid down the debt. Rents have gone up tremendously, and we still have the depreciation on those assets. So it's one of those things where I think everyone has a different view of it. But if I could hold an asset that a little bit longer, and this is what the sponsor can talk about, you're looking for certain kinds of investors. Do your interests align? And some deals you may say to yourself, this deal is great. I don't want to sell this deal. I want to refinance this deal, give you your money back, and let's continue to hold this deal longer term. That may be a viable option for some general partners out there.
Yeah, I agree. And I think a lot of times investors, they regarding the long hold, it's more like they want the rotation, like they want the capital to come back and they can reinvest it somewhere else. So if it's just like too long of a deal, they just feel like, okay, it's kind of a dead deal now, there's dead end kind of thing. So that's the reason I think it's a good idea to have multiple exit strategies.
Yes.
How we talk about that all the time. There shouldn't be one exit strategy, there should be multiple exit strategies. So that way, it gives the deal more confidence. Our
Yes.
investor has more confidence in the deal as well. So I'm going
Well,
to ask the audience at the time, by the time Gino answers, if you have any question, please add to the Q&A. Go ahead, Gino.
I was just going to say a reason why it's not popular with the syndication is most syndicators don't have a lot of money in deals, so they don't want to hold it long term, and they get paid when the deal matriculates when there's an exit on the deal. I would just say, hey, if you're a sponsor and you can put more money into a deal, you put money on the LP side. So you have money on the LP side, and then you have a portion of the general partnership, and you hold that deal longer term, and you're able to refinance that capital out and get some of the capital back on the LP side and get some of the capital back on your GP side. And you hold it and you continue to create yield with that deal. That's how you create wealth. The name of the podcast, the name of the show is Wealth Builder Masterclass. That's how you build wealth long term. It's not sexy. It's not quick. It may take several years to do it, but that's what the wealthy people do. I interviewed Sam Freshman. I don't know if you know Sam Freshman. He wrote that red book on syndication. He's probably in his 90s. He said there's two mistakes he made. He didn't buy enough real estate and he sold too soon. And that's the reality. Now he has investors that started out with him. His grandkids own those deals now. So he has deals that he's owned for 30, 40 years. But that's what he said. And I think when I take that to heart, I'm like, okay, it has to be the right deal. You have to be in the right market. You have to have jobs and population. You have to have a good build. But if you have all of that, I want to hold that deal long term. That's just my mindset. That's my exit strategy.
That's true. So it's a different kind of mindset, different kind of investor. So there's
Yes.
a question from Mel in the chat. You want to read that or you want me to read you?
I don't see it. You want to read it to
In
me?
the chat, yeah. It says, Gino, in targeting a good investment, what are good metrics for the purposes of raising capital? For example,
Mm.
GPLP splits, cash on cash, preferred returns, equity multiple, IRR, and reasonable holding period. What do investors want these days? And what would you consider the most marketable opportunity, regardless of asset class? What LPs are shopping for?
We talked about this throughout this entire episode right now. I think they want trust. That's what they're shopping for.
Exactly.
They're shopping for trust that they're going to get their money back. And they're shopping, well, obviously we talked about the performance part. And we had just mentioned 70-30, 80-20. We had mentioned 8% preferred rate of return. Maybe a 2x multiple. So if you put 100 grand, maybe in 5 years they get to 200 grand. It really depends upon the operator. If you've got a ton of experience, you have more leverage. And life is all about leverage. If you're just starting out, you may have to go 90-10. You may have to give the majority of the profits to the people you're investing. But then after you have that first win, then you can demand more as you go on. And let me see, the most marketable opportunity, regardless of asset class. As far as asset classes right now, everyone was gung-ho on industrial. It seems like industrial's pulled back a little bit. Self-storage, I don't really hear that much about self-storage anymore. That was going crazy for a while. I think if you can get into the retail centers and certain parts of the country where there's an opportunity to buy them at 50 or 60% occupied, they're not really building a lot of retail in a lot of parts of the country. those are tend to be sleepers. You just need to know what you're doing with commercial leases and all. It may be harder to scale that, but I think I think those are pretty good. Those are pretty good opportunities. They're not building that much retail right now.
So, and the retail has to be like certain kind, right? Maybe kind of luxury kind of, or the well needed kind of thing, because retail is going out of business too, since
Yes.
online has the digital market has kind of taken over the world, these
And it's
days.
interesting. You'd want a shopping center that has a pizzeria, a barber shop, a nail
Exactly. A
salon.
nail salon.
Yeah, I mean, and they're not sexy assets, but they can do rather well with those. And if you have a decent anchor store on that, those are really nice assets to have right now because you can't get that stuff on online. And I think that those are we looked at them, they're just a little too small for us. And our whole motto, our whole big, hairy, audacious goal, and if you're talking to sponsors, ask them about their core values, ask them about their mission statement. We want to be the Chick-fil-A of apartments. That's what we want to do in our space, in our niche. So we would tell that to our investors. We were really obsessive and trying to be as obsessive as possible about managing these assets and delivering customer experience. So if we shift over to shopping centers, it's a completely different asset class. We don't know how to manage those. And we're pulling our attention away from one here to another there. And if you're talking to sponsors and they're running the deal, that another good question is, well, what different types of asset classes are you invested in? Are you invested in all these different, and how are you handling that? How are you managing that? If you're not managing it, who's managing? Like who's the property management company that's managing that asset?
That's true. Yeah, I like that. So let's talk about this scenario over here. So let's say there are two operators and each have 2,000 investors, kind of similar experience, good opportunities, yet one consistently fills raises where the other struggles. So, what will you examine before telling the struggling operator that they simply need more leads? Because they already have 2,000 people in the database, right?
Yes.
So obviously, they do not need the new leads. What would you tell them to do differently?
Oh, for me, it's about the brand as well. I mean, when you think about it, Jake and I started doing the podcast back in 2016. And then we started doing live events. And from there, we started creating a significant database of investors, but you just can't keep the database there. You got to provide value for the database. And just because you have 2,000 investors, are they active? Are they engaged? Are you providing value to them? And you have to create some type of culture or community within those investors and just can't say, hey, I'll hit you up when I got a deal because they're going to feel used. They're going to be like, well, this guy's only coming to me when he has something for me. I think for me, it comes down to the brand. I mean, for us, we used to have investor events. We would go up to New York and have our investors, we'd meet them at certain areas. When we had our events, multifamily mastery events, we had our investors there as well. It was friggin' cool. It was a lot of fun. You get to meet these investors, you get to make these connections with these investors. And then all of a sudden, you're not just a commodity, you're a relationship. That's what I think people are craving. They're craving community. And if you have an investor database like that, man, that would be awesome to have some type of event where you rent out a room for some place and have an event once a year for them and get them all together. And I know a lot of people are going to say, "Well, I don't want my investors speaking together." Well, that may not be good. They may be. Well, I mean, if you're the type of sponsor who's transparent, who's authentic, who's honest, who's above board, and is trying to do their best, I don't think you have anything to worry about. We were getting to that point right before 2020 where we were starting to do these little events. We were starting to get people together, and it was creating.
Silence.
It was creating like that community, but they wanted to learn more, and it was creating value for them because all of a sudden now they knew. And it's funny we got on the webinar and we talked about the deal, they knew exactly the kind of deal we were bringing, so it was pretty much a no brainer for them.
That's true. I agree on that. I think when you do the events, it's multiple touch points, and
Hmm.
that creates a stronger relationships right there. And this is a relationship-based game, like we are talking about earlier as well. So it's not like that you just have the database and you send the emails or text messages and you're gonna be able to raise that way. So I
Hmm.
think events are, and we do see a lot of events these days. Everybody's holding events this way or that way to build strong relationship with people. So there's a follow-up question from Mel. I'm gonna read that, or you want to read it? How
How are
are
you?
you navigating through, right? Go ahead.
Yeah, so how you're navigating through rising expenses such as insurance. Our insurance has actually been stable because we're in a pretty good market, and I think insurance is actually going to be going down, especially here in Florida. Replacement costs or other factors influenced by inflation. How are you offsetting these costs or capping them to the best of your ability? Preserving margin. Well, the first thing we're doing is when we're going into a deal right now, we're underwriting, we're going in eyes open. We've done budgets every year. We know exactly what our budgets are. We've got 1,900 units. We know the average of each property, and we take the average, so we go in there eyes open. It's really, really important. And as far as talking about costs, we have a doc where we have our entire 8 different offices have pricing for everything, whether it's flooring, whether it's painting. So we know how much an office in Knoxville is paying for painting as one in Morristown. The costs are similar. So we have to really keep a really great cost there. We go out and we're making sure every year that we're looking at insurance and we're pricing it out. We want to make sure that each guy, we're getting 3 bids on everything. We have to 100% to do that. As far as the other stuff, we don't really buy anything from China. We go to Lowe's, HD Supply. Those are the 2 places that we use. But as far as it's interesting, that's where we've gotten bit over the last 2 years. Those costs have been real. Those rising costs have been real. There's really not that much that you can do. You don't want to cut on certain areas like marketing because you still have to fill the units. But in certain areas where you can commoditize it, whether it's landscaping, whether it's garbage, whether it's internet services, whether it is labor, whether it is what you're just talking about, all these other hard costs, whether it's flooring, we're making sure that we're getting multiple bids on each um, on each vendor.
Okay, here's another question follow up. Have you ever reached a limit on investors from your current database?
I wish I had that problem, right? If so, how are you continually growing your database, social media, newsletters? Well, I've started a newsletter for my family company. Just started that out. For me, it's we started a podcast years and years ago. So the podcast, I love doing the podcast. I love getting on, and it's as if I'm talking to somebody, in the camera. I'm in a room. So I've been doing a podcast for 10 years. Obviously, social media and YouTube. If you're really serious about this business long term, you have to have a YouTube channel. I'm sorry, you have to be out there educating people, and also when you're doing stuff, you're probably going to be doing some stuff on Facebook as far as some Facebook ads, pushing people to webinars. In-person events is great. You can do multifamily meetups. Multifamily meetups work really, really well. And in-person events, that doesn't mean just your in-person events. That means you can go to other people's in-person events as well. You need to go to multiple different seminars, raising events. And I don't have an education platform anymore, but I would join education platforms, raising platforms, people who are teaching this stuff, not for the education, but for the people in the
Network.
education, for the networking of it. And you just try to choose groups that have been around for years because you need several years to build up some type of community so people have some type of results. But for me, I've joined multiple different groups and I've benefited tremendously with the masterminds and with the different groups out there. So I would definitely check out other people's groups.
Yeah, I like that, and that's the best way to do it.
Gino,
Gino,
you've got a
you
great
got a
voice.
great voice.
Well, it's interesting. I sing opera, so I'm actually been performing and doing some vocal training. It's one of those things where you can't be doing business all the time. You have to find something that makes you laugh and something that embarrasses the kids. So that's what I've
Wow.
been doing.
So share with us what vocal exercises you do. You
So
just
vocal, I have vocal trainer. So it's just basically warming up. Me, so it's a lot of different vocal techniques. I love it. I mean, I never knew I could sing. I found that 4 or 5 years ago, and it's just something fun. I think we all need a little bit of what I call the creator artist. We all
uh-huh.
need to step aside, step back, and really fill ourselves with something we love. Whether it's hunting, whether it's fishing, whether it's gardening, whether you have animals, whether it's a hobby. My kids love to do pottery. They love to sing. You have to enjoy that because when you get back to the grind, you have to be energized. You have to really love what you do. And when you're going out there raising capital, you have to have a smile on your face. You have to seem as if you love what you're doing. Because if you don't have that energy and you can't transmit that energy to the other person, and if you're not excited about the opportunity, how is that person going to be excited about the opportunity?
I love that. Oh my God, that's super awesome. I need the vocal training. I'm losing my voice. It's been like 6 months. I can hardly talk. I'm
Oh,
getting some kind of throat irritation. So I lose
so
my voice intermittently. I don't know. And there's nothing wrong. I did all my tests. Everything is fine. So I don't know what's going on.
So vocal coach, just yeah, just I would say go just
Yeah.
Google vocal coach. And for what I do is I do about 4 or 5 minutes worth of exercise a day. He's actually got me singing a German piece. I've never spoken German before because I'm just trying something different. I'm always singing in Italian. So just to try something different and to try to learn something. So my brain sort of rewires itself. It's sort of a challenge. So I'm gonna do a little German, but then hopefully next few weeks get back to Italian.
Yeah, that'd be super awesome. I think it's good
Yeah.
to rewire the brain and plus tongue twisters, it helps you.
Mhm.
Maybe I'll look into that as well. So let's get back on to our questions now. So I'm going to ask you the most important question now that everybody
Mhm.
asks. Everybody thinks, oh my God, I have the deal. The capital is going to show up basically, right? So
Uh-huh.
when does a capital raise really begins? Does raising
Ah.
capital actually begin when an operator gets the deal under contract? Or does it begin months or years earlier through reputation, like we're talking about the networking, relationship, even education? Education is the most important piece.
It's interesting. One of the most important things that I learned was in real estate, there are two things that you should always be doing. You should always be sourcing for deals and you should be sourcing for capital.
Mm-hmm.
That's the reality. And if a deal falls in your lap, you're going to start scrambling for the money. And when I say sourcing for capital, you need to start planting seeds for people and all of a sudden say, hey, I'm the pizza guy. But you know what? I'm doing this multifamily things, Vinky. And if I ever find a deal, do you mind if I just hit you up? This is family and friends. And they're going to be like, seriously? Really? Yeah, just hit me up. But they're going to still think of me as the pizza guy. And that's what happened on my first deal. My very first deal, Jake and I, it was incredible. Like we got the deal, we got seller financing, we were able to scrap the money together, so we didn't have to raise the money. But on the second deal, I found my business partner Mike, who I have to this day, and it was one of those things where I was actually planting seeds with him. I said, Mike, you're buying single family homes. Why don't you invest with us? Why don't you come with us? And you're always looking for those opportunities. You're always trying to get out there and trying to talk about your deals. And then by the third deal, we have people knocking down on our doors. I got family. I got my mom. When are you getting another deal? Can I invest with you? It's the weirdest thing in the world. So if you're out there and saying, I need to get into real estate and buy a big deal, just do a deal. Then all of a sudden you start seeing the naysayers will be like, I'm not investing with you. And 6 months later, a year later, they'll be like, this guy's actually doing deals. So for me, it's always both. You have to be doing both at the same time. And even though Jake and I didn't do syndications until probably our seventh or eighth deal, we still had some JV partners in the deal, right? We still started building that list so that one day, if and when we needed to do the investments, we had a viable list out there.
So beside prepping them saying that I'm investing in real estate, I'm looking for the deal. And when the deal comes, you say, oh, I got another opportunity, or I got an opportunity. So then you reach out to them. That makes the relationship still
Oh,
very transactional, right? So what
yes.
other value do you add to them when you do not have a deal?
So when you don't have a deal, depending on where you are in the world of it, for me, when we were doing it early on, I wouldn't reach out to a person cold and say, "Hey, I've got a deal." I would have made sure that I was on a routine with that person every 3 or every 6 months, just reaching out, seeing how you're doing. I'm just bored right now. I want to create the relationship because if I'm talking to you for the first time and I ask you, "Hey, you want to invest in my deal?" It's like the crock brain's like, "What's this? This guy's trying to sell me. He's coming to me right now." For me, when we had the list, that's why I would do the YouTube channel. That's why I would do the videos because I would send them the videos. Now with the newsletters, you send them the newsletters. You want them to be top of mind for you, and you want to really create value. I created a little booklet years ago on raising capital. It was like a 30-page booklet. It was the time when Grant Cardone had those little booklets out. I had one of them. I would send it out to people. It was just a little thank you, a little PDF that I'd send out. They'd see it. It's like, oh, okay, this is really cool. Those are some of the things that I would do.
Hmm. So like adding value, like educational, kind of teaching them what to do. And
Yes.
sometimes, uh, people have huge databases, they're doing all these things. They're sending the newsletters, they are sending the nurturing emails, but still nothing is happening for them. What they're doing wrong compared to others.
I'm sorry. Repeat that question because someone wanted to know what the YouTube channels were.
Yeah, take your time. Yeah, you added that. I think it said and wrong in there.
Oh, and yes, and Barbara 360. You're right.
Added that.
Because see, I can't do two things at once. I am not a very smart person. I have to focus on Vinky, or I got to focus on the chat boxes. Just one or the other. I can't do both.
Everybody's like that. Not everybody can do that. Only you can do only one thing at one time. That's a misconception. If somebody says, "Oh, I'm a multitasker," show me if you can do more than one thing at one time.
Well,
You
it's one of
cannot
those things.
sit and stare
I
at
don't,
the same time.
some people may, but if my wife is speaking to me and the TV's on, it's either one or the other. Or I'm either watching the TV or I'm listening to. I cannot do both. And if you are listening to somebody, you're not really listening to somebody. That's the
Exactly.
reality.
That's what I was
Yes,
saying. Because see, there's a book called Flow by
yes.
Dr. Mihai.
Oh, I didn't
I'm not
read
sure
that.
if you read that book. Oh, you should
No.
read the book. In there, I think he kind of compared that the human processing to the computer processing. So, like for example, it says only like our mental processing 160 bits only, right? So whenever we're talking to somebody, like one person, so 60 bits are concentrated to that conversation only. And if somebody else started talking, like you said, your wife, she can watch the TV and she can talk at the same time. So you can, dedicate another 60 bits to that conversation or to TV or something. You can run two things maybe parallel, but you won't have
Oh,
100% understanding. But what if the third thing comes now? Now
yes,
it's zero attention because you can't do it because you only have
yes,
like maybe 160 bits. Now using 60 here, 60 here, 120 is gone. Only
yes.
like 40 basic remaining. So this is like whole hodgepodge there, then you can't get anywhere.
So
It's kind of funny.
this is a great parallel to what we're talking about when you're raising capital. If you're
Mhm.
looking for deals, raising capital, underwriting, there's so much going on. I think part of the day needs to be focused on whatever it is you're trying to accomplish. You can't underwrite and raise capital at the same time. You need to take raising capital seriously. You need to, and I think that's probably one of the things that we didn't stress enough. You need to take it seriously. You need to take it as if it's part of the business. And that's one of the reasons why that we sort of stopped syndicating because it's like we need to like have a full we already property manage these deals. We're already running these deals. We're asset managing them as well. We're acquiring them. We don't have a big team. This whole syndication process of raising capital, you need to have staff for that. You need to have CRMs for that. You need to have daily or weekly touch points. It needs to be taken seriously. And if that's a component to the business and it's like, wow, I'm going to wait till I find a deal. It's your ship has sailed. It's too late.
That's true. And I'm gonna ask anybody has any question, please use the Q&A or the chat box. And I'm gonna ask you another question. This is the most important question that I'm gonna ask you. So do the capital raisers, they talk more or listen more? That's a very important question that everybody should know or hear your answer.
In my opinion, and I've heard this from a couple of mentors, I think even Zig Ziglar said it. God gave us two ears and a mouth for that reason. We should listen more. And I think when people talk about communication, they think that communication is speaking when
Right.
actually in reality it's actually listening. I think Jay
Listening.
Abraham said it best. Jay Abraham said to be interesting, you need to be interested. And that's the reality. If you just sit down and listen, and this comes so clear with Chris Voss's book, Never Split the Difference. When you talk about negotiation, everyone thinks about the negotiator as the person slamming the table and making all the demands. When the really powerful negotiator is actually understanding what's going on and listening to the situation and understanding the person's problem on the other side. And that only comes through listening and asking empowering questions. And if you can put those two skills together and really be empathetic, as Stephen Covey says, seek first to understand, then to be understood. That's one of the seven habits. If you can do that, first understand what's going on with the other person and really listen to them, they're going to be heard. If you're a capital raiser and you're sitting down and intimately listening to Vinky and asking her about her goals and asking her where she's put her money and asking her about her fears and asking her what she wants to do with these investments and what she sees 5 years from now and 10 years from now. And you can all extrapolate that. And on the next conversation, you've heard all that and you've digested all that and you're able to really give it back to her. She's going to feel felt and heard. She's going to feel as if She's had a great communication with you. And it really comes down to you listening. But the only way you listen, honestly, intuitively, is to shut everything off and really pay attention and not worry about thinking of what you're going to say in
The
response.
next, yeah,
It's
agree,
hard.
100%. It is.
It's very hard to do because once again, we're ego driven where it's all about us. What's in it for me? When in reality, if you can step back and the great leaders do this really well, they're listening to their team, they're getting input from their team. Then obviously they have to make a decision, but you can't make a decision just based on what you think. You really got to get a lot of input from other people and really let people feel as if they're being heard.
I know. And I remember I come from a corporate world. I was in corporate America for 20 years. So I remember that we used to say that whosoever speaks first loses. Because I was negotiating a
Yes,
lot with the vendors.
yes,
So
yes.
if you speak first, whosoever speaks first, they're gonna lose it. So better stay quiet and listen.
I love that. That's great. That's excellent.
And then I'm going to ask you a follow-up question on this. So, what should an operator know about an investment before deciding whether a particular opportunity even belongs in this conversation? Because if you listen, you will know within the next 5 minutes, maybe 2 to 3 minutes or 5 minutes, that this is a right fit or no. Because
Mm.
sometimes you're just like, I'm going to use the word wasting your time, but that's the right thing because you're just kind of on the roll and sharing everything when it doesn't even matter. It's just like you can use that time somewhere else.
This is where the framework comes into play for me. When I started out, I had life before Jake and then life after Jake. That's how I split my investment career up. Life before Jake was a disaster. I made so many mistakes. I didn't know what I was doing. I had no map. I had no process. I was just looking for deals, as I had said. Then when we met Jake, we created this buy right, manage right, and finance right. And I'm going to lean on this again. As an operator, and this was incredible to me back in 2022 or 23, we went to Dan Hanford's event. Dan Hanford had a great event out in Charlotte, and it was capital raising. And Jake and
Mhm.
I were on stage, and we asked the syndicators out there, how many of you have a buy right box? By a show of hands. And it was crickets. Like nobody had a buy right box. We were shocked. So to answer your question, when we're looking at a deal as an operator, as a sponsor, you need to have a specific criteria on what you're trying to accomplish with your investments. Every market is different. Every operator is different. Everybody's strategy is different. But our buy box in our market in this part of the market cycle is we want 20 to 300 units. We want newer vintage. We want assets that hopefully they should have. We'd love to have washer dryer hookups in them because that's a great amenity. And residents want that. It's an awesome amenity and it keeps and it retains residents. We like 2 bedroom, 1.5 bath townhomes. We love units that have brick, but we'll take siding. If they got garages, even better. Pitched roofs, not too much, but we can deal with them, but we don't really like pitch roofs. We've had some assets with pitch roofs. They're a pain in the ass. Median incomes of at least $50,000. Now, to your point, when a deal comes across the desk and we're looking at an asset, we can check off that box in 5 minutes. If it's something that's really old, really outdated, low median income, we just pass on it. And then we can actually, as we're having our webinar or we're talking to our investors, we can have it on the slide. This is the buy right box. And look, this checks off all the boxes. And why 2 bed, 1.5 bath townhomes? Because it feels like an apartment home. There's more stickiness to it. Why washer dryer hookups? Because that's what residents want right now. Why $50,000 plus median income? Because that's a more stable resident base in our market. Why brick? Brick lasts a long time. Why newer assets? Because there's less capex involved. So see how granular you can get. Now just figure out where you are in whatever market you are. Focus on a specific criteria. Unfortunately, the criteria does change as the market cycle changes because maybe in 2 years, old assets drop precipitously in price. And you're like, oh, now I can buy these because I can add value and I can run these assets up. But that's what you need to do. You need to be really clear on the criteria. And the beautiful thing about it is once you have it, you shout it from the rooftops. Every broker should know your criteria. Every investor should know your criteria. And when a deal comes and there's a broker that sees that deal, they're going to pick up the phone and they're going to call you because they know that you are looking for that type of asset.
Okay, that's good. So let me ask you regarding the investor side due diligence now. So
Hmm.
when an investor challenges an assumption or ask a difficult question, they may also be watching how you respond or the syndicator respond, right? How much of the due diligence is really an evaluation of the person behind the investment? That's what I wanted to know from you.
Oh, that's a
It's a very important question. It seems simple, but
yeah,
people are watching you, the way you're talking, your hand gestures, your facial expressions, because
yes.
that shows them how confident are you when you're answering.
For me, if I don't know the answer to a question, I'm old enough and mature enough to say, hey, Vinky, I'm not really sure where rents are right now in the market. I don't know where we can go. So I have to get back to you on that. I mean, I'm going to be honest as I possibly can to people. And if you don't know something, it's okay. You're not going to know everything. And you can say, hey, I'll get somebody on my team because unfortunately now, or fortunately, you have Chat GPT. Somebody can go on there and they can, and who's to say that chat's right or wrong? Because chat's been wrong in a lot of areas, but people can find out the information and go around you. So if you're trying to hide something from somebody, that's not a good thing. And it's just not. And it to me, just to be open and honest with the person. If you don't know something, it's okay if you don't know something. And if they challenge you with assumptions, and if you're saying, well, we're going to get 5% rent growth, and they're like, dude, you're not going to get more than 2%, you may have to check yourself and say, hey, I have to check that assumption. And you may be wrong. And that may be a good thing because maybe you were overestimating it and you may have to go back and change your assumptions. Or you're saying to yourself, well, my exit cap is going to be, a 5.5. Well, I mean, really, do you think you get, I'm just saying, do you think you're going to get that? You have to challenge yourself sometimes and say, is that accurate? So for me, I love those kinds of questions. I love when somebody's talking about a deal and picking a deal apart. And if you love the deal and you vetted the deal and you're putting money in the deal, you should challenge it. You should want people to be that because then all of a sudden now, when they're asking questions, that means they're engaged. That means they're interested in the deal. People look at it at another way, look at it from the perspective that, hey, they're actually interested in a deal and they're actually asking me about it. Now, what you could do is you could do something called an accusation audit that Chris Voss talks about. You can say to them, hey, give them the bad parts of the deal. So then you can objection block in the front end. Yeah, this deal is a little bit old and the median income is not 50, it's 46. Put it up front. Then you say, but this is why. So you can always, list out anything that may be accusatory in the deal. So you put it out in front of them and you block their objections before they can even ask that or bring that up.
I think objections are good. Those are not the
Yeah.
showstoppers, actually. Those are like help you even, expand on the conversation and build deeper relationships. That's the way I
Yes.
look at it. And then
Mm-hmm.
other thing I do is, when I'm running a deal, I just ask the same question maybe three different times. When I'm
Mm-hmm.
talking to the person three times, I'll ask the same question maybe different way because I wanted to see what the answer is.
Mm-hmm.
Because if somebody's lying, they're gonna forget what they told you first time.
Mm-hmm. Oh, I like that. You could, yes,
Simple, right?
yes, yeah. That's actually interesting. Yeah, that would work. Yes, that
Because if
would.
somebody's lying, they're gonna keep on lying to everybody, right? So that
Yes,
you do not try to remember all the lies because
yes.
it's very hard to remember, who you told what. So it's a good idea to do that as well. Just be simple. I think simple approach is the best approach when you're wedding a sponsor, wedding a deal, because you have to be true to yourself first of all. Because a lot of time you're not truthful to yourself. You don't even know who you are, what you want.
Mm-hmm.
That's the clarity. Everybody needs to have that.
I think
Now,
also, Vinky,
mhm.
when you're looking at these deals, and I'm speaking if you're an investor, if the deal is too complicated or you don't understand it, I would just pass if it was me
Exactly.
because even for us, if we have to maneuver the deal, if we have to get special financing, I mean, if we have to do certain things and we have to make it complicated, it's going to be hard to execute on that kind of deal. We have to understand the deal, and if we can't make it understandable to our investors, and they're scratching their heads and they're saying, "I don't really understand this," a confused mind like you said before, why do people not raise capital? You have a confused mind as an investor. They're going to say no. And I'm telling you right now, if you're confused about the deal and the sponsor can't actually explain the deal to you and they're saying, well, it's complicated, just pass on that deal. Trust me. That's the best thing you'll probably do is just not invest in that deal.
That's true. You need to have the clarity. Clarity is the utmost, clarity and the simplicity.
Mm-hmm.
As long as, if somebody can make you understand the deal like they're, fifth grader or somebody, just think
Mm-hmm.
like that. Don't try to act smart. Don't try to think like I know everything when I'm running the deal. You don't. You don't
Hmm.
know how they underwrote it. So all the assumptions you don't understand, maybe. I don't know. I don't. I mean, I'm gonna be truthful and I check everything. So I'm gonna ask you one more scenario question at this time. We're gonna talk about the operators we're talking about, the capital is now. So imagine an operator needs $10 million for a deal. So they reach 6 million and momentum suddenly stop. It dropped, right? So now before sending more emails, making more calls, or creating any urgency, what should they do to diagnose what went wrong, why the race kind of halts now?
Well, I would say what they would do is, if it was me, I'd start praying. That's the first thing I would do is like, please, God, help me here. I mean, I would try to be as graceful and as humble as possible because it's a challenging feeling. When you're looking at the deal, we had talked about it. I mean, like the deal itself, do people understand the opportunity, right? But they aren't excited about the opportunity. That is it you not communicating the deal properly? You have to diagnose that, right? Then you talk about the message. If the message, and there's lots of confusion, there's a lot of questions, and you can't answer the questions. Was it you that actually screwed up the raise, the capital raise, because you weren't able, like you said, you looked a little uneasy, you looked as if you were hiding something. People can feel that, and then you talk about the terms. Well, look at the deal itself. Are the terms good? Do you want a 60-40 split? Are you only giving them 5%, pref rate? Or are you going to give them their money back in 9 years? Like, look at the terms of the deal and see what your deal is in comparison to what other people's deals are. And then obviously the last one, as the operator, are you looking at yourself inwardly, and have you had some type of a success with other deals? Or is your track record so and people like, I don't really know. So for me, the lens of the deal, the message, the terms, and the operator. That's how I would diagnose that question. And it's really hard because you're looking at yourself and you're judging yourself. And it may be something where you need to have somebody who's a coach, somebody who's not part of your family, look at it and criticize you. And that's really challenging. But I think you need to do that. But at the $6 million mark, you've raised $6 million. The next thing I would do is I would try to go out and find people who raise capital for deals and try to get people help me to raise money. At this point, if you're into the 10, $15 million, maybe you start talking to family offices, smaller family offices. Maybe you start reaching out. At this point, it may be too late, but you should have gone to seminars. You should have gone to different events. Some things that you're looking in retrospect were, hey, it's not this deal, but for the next deal, these are some of the things that I should be doing.
I love that strategy. Like you were saying earlier, slow down to speed up. That's
Hmm.
what is applicable over here. So let me ask you a follow-up question. What do operators do differently when the investor says, I need more time, or ultimately say no, even after signing the documents?
It's one of scarcity. It's fine. We're not a good fit. You know, I read a book by Ian Altman, and his book is called Same Side Selling. And the acronym that he uses in the book, it's called FIT, Finding Impact Together. And as an operator and as a capital raiser and as a business owner and as a salesperson, you're selling something to somebody. You're giving them the opportunity. You want to find the opportunity and you want to sit together, right? You want to be able to sit on the same side. You don't want to be on different sides. If at some point they don't feel as if it's a good opportunity for them, the best thing you can do is to say, hey, thanks. We're not a good fit. If you decide to change your mind, and then people, the average person, I think will respect that. We've had people who are like, I don't really know, and they come back and they feel as if you're breaking up with them. I had an interesting situation happen on our second capital raise, and I remember there was this gentleman who came to one of our events. It was multifamily mastery 2, and he went there. He met the family, and it was a Friday afternoon at 5:30. He calls, and I pick up the phone, and he starts talking to me. And I was about to tell him the deal, and he's like, "No, I'll invest with you." I'm like, "Really? What made you want to invest so quickly?" He says, "Well, you picked up the phone on Friday at 5:30. I met your family. You seem like the real person, and it seems I can trust you." And that's what it came down to. I didn't even have to pitch him the deal. I created the relationship. That's why this kind of forum, this kind of medium is so important. Because once people start hearing you and start listening to you, it's like they're part of you, but they're part of your family. He went to that event. He saw us on stage. He saw me with my family. I was a real person. I wasn't somebody who was just trying to raise money from him. And I think when he had that relationship and that conversation with me, it just solidified things for him.
Hmm, that's a good one. So, follow-up question on that. What makes an investor say the deal did not go exactly at plan, but I would absolutely invest with this operator or this group again?
That's an interesting question. I think a lot of investors at a certain time, not every deal goes well. You may be a sponsor who's done 30 deals. Some are home runs, some are base hits. But once again, we'd mentioned about it. If that sponsor is only getting an 8 or 9 IRR on a deal, and the investor says, well, you promised 15 or 16, and the market was doing crappy, you could at least say, hey, I did a lot better than what the market did, right? I think investors understand that. But if you're constantly talking to them and saying, hey, this is why we aren't doing good, CapEx, the freaking hot water heaters are costing us so much money this month. And all of a sudden, we have to turn these units and it costs a lot more. And now all of a sudden, the market shifted. All of a sudden, it's not 95% occupied, it's 91%. And we can't get above 91%. And there's so many units being built downtown that we didn't expect this, but that's what happened. If you're telling them that, and by the way, that all happened to us. So this is not something I'm making up. But if you're on there and you're consistently telling them that and you're letting them know, then they're like, oh, okay. He's been through the thick and the thin, and it's not only us that's losing money. He has his own money in this deal, so he's not getting is performing as much. That's some comfort to them because they're like, I'm not the only one who made less money. And then I think if you can show to them that you're putting in all this work, because I think investors are just regular people. They see that you're working your ass off on these deals. You're dealing with these tenants. You're dealing with the management on this thing, and every month, and then there's issues after issue, and you're trying to redress them, and you're not burying your head in the sand. You're hitting them head on.
That's
I
true.
think investors really, really respect that. I mean, it's not going to be any less of a blow because they're making less money. That at the end of the day, they're looking at the returns, but they can at least say to themselves, these people are at least honest and forthright, and I at least got some of my money back.
That's true. And I think the bottom line is the communication. That's the most important factor over here because the investors who invest passively, because they have something full time, some full time gig, corporate job, doctor, engineer, they're busy schedule, right? They do not
Hmm.
have time to do everything on their own. If they had, they might not invest with anybody else. They just do it themselves. That's the reason they're riding this syndication wave with other operators. But they want the complete experience, whether it's
Yes.
good, it's bad, or ugly. And
Hmm.
if you do not give that experience, if that experience is missing, you lose that investor. And that's what
Hmm.
you said very well. So
Yes.
there is another question from Mel in the chat. You want to read that?
Gino, in reaching out to family offices, fund managers, endowments, what is the best approach to secure a meeting? In your opinion, how long will it take to nurture those relationships to a point where they know, like, and trust you enough to meet with you? Family offices are going to scrub you up and down. They're going to do a lot of due diligence on you. You need to have experience and you need to have some type of credibility. For me, you need to have the website. I mean, if you've written a book like we did, we've done a couple of books. If you're credible, if you've done several deals, then I think it's time to start looking at that. There's a lot of family office meetup groups. I think Richard Wilson has a really big one. I would join that and start involving myself into that conversation with those types of people. They are focused on preservation of capital. So, but it's interesting. They went from 7 or 8% of alternative assets to like 25% of alternative assets in their portfolio. And they've shifted a lot into the real estate space, whether it's real estate investment trusts or it's syndications. I think at some point when I'm talking to a group like that, I really need to show them what I've done. I really need to show them my portfolio. I need to show them that I've experienced success in the deals. I think we'd be able to do that. We'd have that. For me, getting in front of them, it comes down to you may lose some autonomy because they may want a little bit more flesh. They're going to give you write you these big checks. So there may be a trade-off between going with with a big family office as opposed to smaller investors. So that's the trade-off. On the other hand, the family office is going to be able to stroke those bigger checks. So when you're talking about creating and nurturing the relationships, is you need to go to their events. You need to go to all of these different events that have family offices and have doctors' offices and have dentist groups, and start getting yourself in there and start talking and start handing out, quote unquote, the proverbial business card. But still, it's something that's really important to get into those groups and to really let them know what you're doing.
That's true. It takes a long time. It's a not long nurture process. So
Hmm.
I'm going to ask you one golden question now before we end our session. So until now, I've been talking about just raising capital and how we should do it, you know. So why investors are hesitant, why they're saying no. So I'm going to flip the question here. So I'm going to ask you this. When should the operator to be the one to say no?
Oh, I hope every operator or every sponsor out there has a set of core values.
Mhm.
We have people first, unwavering ethics, extreme ownership, make it happen, and growth mindset. Those are our core values for our education company, for our property management company. As a operator, you need to have core values, and they need to be used for vendors. They need to be used when you're hiring employees, and I think they need to be used to to solicit and to get investors on board as well. And if an investor is going to violate one of your core values, it's probably not a good fit. I think another thing with investors is you have to make sure that their reality and their objectives align with yours. If they think that this is a guaranteed get rich, they're not going to lose money, it's not a good fit. You have to explain it to them that there is risk in this. You also have to understand that if it is their last 20, 30, $50,000 and they're going to invest it with you, it's probably not a good idea to take that money. I mean, being realistic and being honest with them, letting them know worst case scenarios and if they can deal with that. Because at some point, the people who write the smaller checks, they tend to be a little bit more needy because they don't know how the business is and they're giving you a lot of their capital. So you have to make sure that your interests align with them, but you'll also have to make sure that your core values align with theirs. If they're going to be annoying, if they're going to bother you all the time, they're going to constantly call, and you can feel that as an investor. Vinky, I had an investor. I remember on our last deal, we had just sold, and he emailed us and he made a ton of money. He emailed us and he started screaming on the email, our K1s are wrong and he's going to sue us. Okay. 2 hours later, the email comes back and goes, "Oh, you know what? I'm sorry. No, it wasn't your fault. We made a mistake. Oh, by the way, do you guys have another deal? Can we invest in your deal?" I mean, am I going to invest with that investor? Am I going to allow that investor to come into our deal? It's something simple, but you should have a feel for these investors. You should want to work alongside these investors because they are going to be your fiduciary responsibility. And once they invest in your deal, they're the highest priority. It's not your deal, it's the deal for them. And what you have to do is best for them. So you have to make sure that the fit there's an alignment there.
So, like you were talking about the scarcity earlier, so I'm going to ask you follow up on that. Do you think the operators who know when to say no ultimately become the operators that investors trust more?
Oh, yeah, yeah, oh, it's like any brand that you have out there. When you can say no to somebody, you become more attractive to that person. I mean, that's the reality. I mean, that's why you see it in so many things. You have to apply to work with us. They're trying to make it as if it's something elevated. Why does Louis Vuitton cost $5,000 for a bag? Because not everyone can afford a Louis Vuitton
Or
bag. It's only exclusive. So, I mean, at some point, that's where you may want to build your brand, but you want to make it feel as if you're offering them an opportunity. You're not just taking their money. You have to say to them, "Hey, you're investing in our deal, but this is an awesome opportunity. I mean, like, this is something that we really treasure, we really value. We want you to be part of this." But it's not as if you're being desperate and you're begging them for money. If that's the vibe or the feel that you put out, then you're really going to struggle with money, and then you're going to get any kind of investor out there, and you don't want that to happen.
That's true because you are losing the freedom for yourself. So when
Yes.
you're not free, like you were talking earlier, like you do your vocal exercise, you love to sing. So you need to have some hobby because hobby is not just like hobby. It's just like give you that space where you
Hmm.
get more clarity about yourself. Because
Yes.
by doing that, you're creating some space in your mind from all the chaos where the creativity comes in. So
Hmm.
if you're missing
Yes.
out on that, you're just kind of on the hamster wheel all your life. So
Hmm.
that's
I
not a good
agree.
place to be. Yeah. So let me ask everybody else, do you guys have any more questions? If you do, please, we are over time now. Everybody's still here. Most of the audience is still here. Look at that, Gina. That's they glued to you. So if you have any questions, please ask. And by the time, Gino, can you share with us how can people reach out to you after listening to you for 90 plus minutes now? So somebody wants to connect further.
I mean, if this has resonated with them and they want to learn more about the real estate, just go to jakeandgino.com. That's where we have our podcasts. That's where we have the blogs and all. And if you want to learn, about family, about creating a legacy, about a little bit about business coaching, we have a company called Barbaro 360, which we didn't even talk about. It's a family company that I created with my kids. And our family really thinks that family is at the center of everything. And what the wild thing, the interesting thing is when you're building a business, it's as if you're raising a family. You have so many similarities, whether it's core values, whether it's mission, whether it's family governance, whether it's rhythms and cadence of accountability. It's the same thing in a family. And we see that that's missing in families right now. And I just love family life. I want to be a proponent of family life. So we've created this company really to teach people how to, grow and nurture their family while they're being entrepreneurs. We don't want them to drift apart from the family. We want them to actually incorporate family and business into their lives. So you can go to barbaro360.com for that.
Great. Thank you so much. I do not see any more questions from anyone. So, but I really love whatever you share. I mean, thank you so much for sharing your experience, your perspective with everyone. And then, everybody here, you guys are still here. Thank you so much for staying 90 plus minutes with us. I'm pretty
Thank
sure you
you.
have enjoyed this conversation. And I think you have some more clarity now, not about how to raise capital, maybe about you can ask better questions now and you have maybe deeper perspective, or maybe you can make some more better or informed decisions. So at this time, I would just say continue learning, continue asking better questions, or continue with your due diligence. And also, the most important one that I say all the time, continue building your wealth wife. That's actually my podcast as well. So tune into that if you haven't yet. So we talk about the wealth building strategies in that podcast as well. So once again, thank you so much, everyone. We'll see you next time with another awesome guest. I think that's going to be Kim Lisa Taylor. So we're
All
going to be talking
right.
about how to structure the deals in this chaotic market. And thanks again, Gino. Any last words for the audience?
No, for me, just it may be challenging right now, but as I said previously, this too shall pass. And you'd mentioned clarity many times. We don't lack the motivation, we lack the clarity. Just try to understand what you're trying to accomplish, and this market will get better.
Agree, 100%. Wow, so good to see you. Thanks for
Thanks,
an
Vinky.
insightful session.